All right, we're on. Welcome,
Excellent.
everybody. January 14th, 2022, 2 weeks in, mid-month Q1. Ben, how we feeling?
Pretty good.
Yeah?
I think. Yeah.
Pretty good.
Pretty good. Yeah. Lots, for the clients that I talked with this week, and if you've been following my dailies, big news start to the year. I guess we're 2 weeks in here now, but quite a bit more action in the first 2 weeks from a macro perspective and central bank perspective than I thought. I thought it'd be probably closer to the end of February, early March before we saw some of the action that we've seen the first 2 weeks. So quite a bit going on, more than I anticipated.
Yeah, definitely. Well, it's certainly been busy for us. So start off with a couple of housekeeping things. Number one, I just mentioned off the top for people that are just joining that I was happy to see people are joining us because we started using a new email system there today, which allows us to do more mass emails as a group. So before it was just Ben using it, doing it through his Outlook, which obviously is not very efficient. So we're doing a more of a group email system here. So, and it comes from service.hart@nbc.ca. So that's also the service email that we're going to be trying to use more often as well. So for those of you that are seeing this in the recording or getting it late, if you didn't see the email, you should check your junk mail and make it a safe email. A couple of other things here on the housekeeping contributions. They've been coming in fast and furious. TFSA and RSP contributions. RSP contribution deadline is March 1st, 2022. So please get those in whenever you need to, or whenever you can. That'd be great. The other thing too is that I'm going to be sending out some emails and giving everybody a call over the next few weeks myself, just to see where everybody's at, see if there's any contributions, see if you want to add more TFSA, see if you have more to invest your account, see if you have all your insurance needs, anything that there is that you want. So please expect that email from me and probably a phone call as well. That's a lot, Ben. I'm busy.
Yeah.
Ben keeps me busy. He's pushing me. Guys, tell him to back off.
Good, you get bored otherwise.
Yeah, exactly.
Right?
Exactly. All right. Well, let's get into the exciting stuff now that we got all the housekeeping behind us. What's up? How was it the week in the markets, Ben?
Pretty good. I mean, pretty good, I guess, from the perspective that I think I don't remember what day it was, but I believe probably was it Tuesday or Wednesday? The weeks are going by so fast, but I think it was maybe Tuesday where I put out that it looks like things have changed. We came into this year with the expectation that growth would continue to accelerate in the first quarter of this year. Looks like we may have actually peaked in the last quarter of last year. So starting to see signs and signals that we may have peaked there. With that, we had Keith McCullough from Hedgeye, who we follow their research, really kind of come out aggressively saying that he thinks we're in kind of going to be in a shallow quad four in Q1. And I listened to his financial expert who came out and talk about, JP Morgan and Citigroup's results today, which are bad, tending to indicate that, it looks like we're going to slow down somewhere around 1.25 from a quarter over quarter perspective GDP, which is a pretty dramatic slowdown. I'll just in one of my charts, I'll show what that looks like. But that means that Q2, which I said, I expected this growth in GDP or inflation in GDP to slow at the same time. Right now, it looks like it's going to be quite dramatic. You couple that with the central banks coming out this week and all saying kind of like, blinders on, Powell didn't say, like he did in 2018, that we're on cruise control or something to that effect, but they essentially did that. All the central bankers this week were like, yeah, we're going to continue to raise rates. We're going to raise rates as soon as our quantitative easing is done. And so, the economy is saying one thing, central bankers are like, I don't care what the economy is saying, this is the path we're on. And so, assuming those two things collide, you got slowing growth, slowing inflation, tightening financial conditions. It's a bad setup. And so we saw tech sell off pretty aggressively this week. And in turn, I reduced any exposure to tech. Still kind of some semiconductor here and there, a few places where we still have some longs, but XLK and QQQ reduced that exposure to pretty close to zero. We've seen a couple of days here as tech was pretty soft yesterday and the day before, little bit of a rally here into the end of the day because it was heavily oversold. But what we've been getting on these rallies is we're getting lower highs. This is a changing trend, right? The NASDAQ kept getting new highs and new highs, but now as those highs get lower and lower, that's a pretty significant signal that we're showing some weakness.
Okay.
That was a long-winded answer to your question.
So are we anticipating this trend's going to continue?
Yes.
Oh, and I should mention too that Keith McCullough from Hedgeye retweeted one of your points this week.
That's
which
true.
Is kind of a big deal.
It is kind of a big deal.
He's Ben's Twitter famous for this week anyway.
Exactly. So I think so I'd expect that any of the kind of the more aggressive longs that we have, I sold any of the small caps too. I'd be taking advantage of rallies to sell those further. And so some of the companies that we owned would have liked to sell sooner, but I'll take advantage of rallies to sell.
Okay, perfect. If anybody has questions, as always, just hover over the bottom, hit the Q&A button and put them in and we'll read them live.
Yeah.
Ben's charts.
Sure.
You got a good setup for us today?
Not exactly what I was looking for. Just we have had some good conversations this week with clients, and one of the information that we'd found out in the research this week, we're just talking about household savings, and kind of the media talks about how much money people have in their bank accounts, but I was trying to find the Canadian data, but the US data shows something around 70 to 75% of Americans only have less than $2,000 saved. So you look at the headline numbers where people flush with money, but you look kind of below the surface, and that's a big percentage of the population that aren't in that position. So as inflation runs and financial conditions tighten, that's not super great for the average individual.
Sure.
Yeah. So let me get the charts up, and we can go through that. Great. All right, let me know.
Yep. You're there.
Yeah, I'm there. Good to go. Yeah. So as I commented on earlier, so this is the view of what Hedgeye has presently on right now, right? We closed out 22 with 21 with pretty hot GDP numbers, and then if we look at the deceleration here from Q1 to Q2, this is obviously Q4 to Q1. It's only about 40-50 basis points, but that deceleration is enough to say that we are in that slowing GDP. And we saw inflation kind of touch 7% in December. There's no way in heck that we're going to see that same number for January. So inflation and growth are decelerating now. And if you look at Hedgeye's forecast, and even Bloomberg consensus is below 4%. That's a 1.3, 1.4% deceleration from what we saw. It's a huge percentage. And so I know people, and I used to think this way as well, where you look and you say, look, it's a good solid GDP number. Who cares? Well, because it's decelerating so fast, stocks aren't going to like that. They don't like that quick deceleration. So, and if you look at that quarter over quarter number, you're going to be somewhere in the one range, like 1.5, 1.6% Q2 GDP in the US, which is super slow given what we've seen in the past. And Canada's numbers are going to be similar as well. But, this is the reason, this is what I say, high growth tech, like these things are going to come under pressure unless something materially changes. And what that might be would be the central bank saying, okay, we're going to continue quantitative easing for another 6 months, which is presently very unlikely. I think they've put themselves into a corner where they have to stop their quantitative easing and they have to raise rates because they've, essentially voiced that to the market, and the market's already priced in 4 rate increases right now. So, so they have some cover to do it. I just think the stocks aren't going to like it if they do.
Good one.
And just a reset on what these mean. And I know we've talked about this probably ad nauseum for some people. But as you move into these different categories, and I think about historical positioning, like 2018, the reason that I keep saying that is, this was Powell last time where he'd locked themselves into cruise control on rate increases. December of 18, the stock market dropped 20%, and he was like, I'm wrong, I'm out, and went in the immediate other direction. So that's the kind of setup we have today. It's also a little bit like 2020. 2020 obviously had a different sell-off result, and that was COVID related. But what I did at that point was held US dollars, which we hold today for clients, continue to add to bonds like 10 through 30 years, and look at buying puts again on the S&P 500, which I'll look to do on a rally, because nothing happens in a straight line. I think that there'll be opportunities to take advantage of selling some rallies and buying some more protection. But the direction we're heading right now is into this quad 4 bucket, which is fixed income, US dollars, and gold are the kind of the currencies you want to own. Consumer staples, utilities, REITs, those kind of things tend to do quite well in this backdrop.
Yeah, that's always good to review this.
Yeah,
there's always questions about the quads. Yeah.
Definitely. And the place that did the best the last 12 months really tend to fall into kind of the worst category here, which is you get energy, tech, industrials, financials, and materials doing the worst in that backdrop. And so, those would be a lot of the things that we don't own anymore. But energy tends to get hit the hardest in this setup.
Gotcha.
Okay. And so this was the last piece. I try to always get a little bit of a crypto take into it as we follow the evolution of Bitcoin and Ethereum. This is from Fidelity. So, part of why I thought it was interesting is you get Fidelity, one of the biggest investment houses in the US and one of the biggest in the world, actually, starting to talk about Bitcoin and crypto and following these kind of long-term kind of S-curve, Metcalfe's law, whatever you want to call it, and just show a kind of a breakdown for how things have evolved. And so, on the top line, this is kind of the S-curve, and Julian Timmer is the gentleman who puts this out, and I think he's the CFO, or the chief investment officer of Fidelity. And so his view is kind of 40,000 is the baseline at the present time, assuming we continue to follow this S curve. And so worth noting and interesting, because we're trading not too far off those levels right now. And as more of the important piece is you continue to see, if it is a true S curve, you continue to see this move before you get the upturn to that S, which obviously is when things multiply.
Yeah. Great.
Comments, questions?
Comments, questions? None yet. I think you undersold the Ben's charts segment. You said, it's not really what I was looking for.
Yes.
All great charts.
That's
all
good. I'm glad. Yeah. Glad. Sometimes you get a vision in your mind and it doesn't play out exactly the same way.
It's the way it goes, man. It's the way of it's life.
Yes.
Okay. So what do we got? What are we looking at for next week?
So I'd say a couple things. We interviewed the CEO of Stack Capital this week, which was a super interesting podcast. It's one of the kind of the few ways to play private equity in Canada where you can buy it on the market. Stack Capital. They're one of the investors in SpaceX, which is Elon Musk's rocket ship company and satellites.
That's a good way to put it. That's a good way to put it.
Yeah. So that should be out shortly. So that should be good for people to watch. But we have something. I think we got Galaxy Digital next week too. We have somebody from there, which is Mike Novograd's company. So that should be interesting. We have that coming up, and on the 25th or 26th, we'll be doing our annual presentation. So more information as that comes, but lots of work going into building that deck.
Yeah, for sure. Yeah, we've got a lot coming up. So yeah, that video is going to be ready next week for the Stack Capital. So I'm just waiting to get that back from the editors. And yeah, we're going to start emailing that out directly to our clients this year. So you won't have to dig around and find it on YouTube or anything. We'll just send you a direct email when that comes out.
Yep.
Yeah, lots to do. We're busy this month. Like I said, the annual's coming out. That's always a big crowd pleaser. So
yep.
Yeah, it's a lot of work for you. So looking forward to that.
Yep.
All right. What else? What else do you want to talk about to round up the week?
I'd say to round up the week, been really slow in a capital raising environment so far this year. Haven't had too many companies come to market. So typically it is a bit of a slow start, but with the market being choppy as well, you haven't had too many companies come to market this so far in these first couple of weeks. Quebec did raised some money. Hydro-Quebec and Quebec government issued some more bonds, but generally a pretty slow start to the year from a capital raise perspective. And then next week, given the kind of turmoil we've had this first 2 weeks, I'd expect we get a bit of a bounce next week as the central bank continues to talk. And so I'd look for opportunities to further sell down some of the riskier positions and add to bonds and US dollars and REITs and things like that.
Gotcha.
That's it.
Okay. And now we're on to the weekend.
That's it.
Just flying by, eh? The weeks just fly by.
Yes.
Well, kids going back to school on Monday, so that's exciting.
It's good news.
Yeah, exactly.
Very good.
Today. All right. So that's it for everybody. Thanks for joining in, and we will see y'all next week.
Perfect. Thanks. Take care, everybody.
Bye.